Today, we're going to talk about 10 dangerous financial traps that we fall into, often without even noticing it. These traps can cost you a lot more than you think. Let's take the example of compound interest. Let's say you invest $10,000 at 5% interest. In 20 years, your total will be about $26,500. And if the interest is 7%, the total will have already risen to $38,700. That's a difference in income of almost $12,200 for the same initial amount and term. That's how exponential growth can change the picture. Now imagine that this is not an investment, but a debt, such as a high-interest loan. If you borrowed $10,000 at 20% interest and missed a couple payments, the amount of debt would start to increase much faster than it seems. After a few years, you may find yourself in a situation where the debt has doubled or tripled and you don't understand how it happened. The general rule of thumb: don't rely on intuition in these matters. It's important to use calculations and projections. A simple compound interest financial calculator can help you assess the real-world implications of both income and expenses. And so, trap number 1, intuition and exponential growth. Intuition is a useful tool in life, but in matters of finance, especially when it comes to exponential growth, it often lets us down. Trap number 2, the attachment effect. The attachment effect is a classic psychological trap that even the most intelligent people fall for. Let's break down why it happens and how to avoid these situations, especially when it comes to your finances. When we see a price tag with a crossed out amount, such as $10,000 replaced by $5,000, our brain automatically sees it as a great offer. We feel like we're saving $5,000. But the truth is, you're not saving. You're spending $5,000 that could have stayed with you. Why does this matter? Because the original price sets what's called an anchor point. Even if an item is not objectively worth $10,000, we continue to think of that amount as the norm and evaluate the offer against it. This is especially noticeable in sales, where prices are deliberately inflated before discounts to create the illusion of profit. How to deal with this? First, ask yourself, if this item had originally cost $5,000, would I have bought it? If the answer is no, then the discount doesn't matter. Second, evaluate the need, not the price. Ask yourself the question, do I really need this, or is it just an impulse? Third, compare it to alternatives. Perhaps that $5,000 could buy something more valuable to you, or even invest it, reaping more benefits in the future. The anchoring effect is especially insidious when it comes to big spending items like cars, electronics, or real estate. But if you learn to recognize this trap, you'll not only save money, but you'll learn to spend it more consciously. And remember, the biggest savings is the money you didn't spend on things you don't need. Trap number 3, mental accounting. Dividing money into important and incidental spending is a common mistake that leads us away from effective financial management. This mental accounting creates the illusion that some money can be spent without looking back, just because it's non-essential. But in reality, every dollar has equal value and can either improve your financial situation or worsen it. Why this happens? Psychologically, money that we receive unexpectedly, like bonuses, gifts, or fines, are perceived as less important than an earned paycheck. We treat it as easy money that can be spent on anything. This is what leads to rash purchases or spending that we later regret. What to do to correct this thinking? Combine all income. Think of any income, salary, bonuses, or investment returns, as part of a single financial pool. Separating it into core and extra money creates unnecessary confusion. Ask yourself, how can this money improve my life or investment portfolio? Instead of spending the bonus right away, consider where it might be better invested, perhaps in debt repayment, investments, or creating a safety cushion. Plan your spending ahead of time. If you still want to spend the bonus or unexpected income on yourself, budget it as part of fun or personal pleasures. But don't let the entire amount disappear without a trace. Remember the value of time. Every dollar is not just a bill. It is a resource that you have earned by investing your time and effort. If you treat money with this mindset, it becomes easier to control spending. Finance really knows no artificial categories. Every dollar is an opportunity to either take a step forward to financial freedom or a step back to unnecessary debt and stress. So approach money with respect and it will start working for you. Trap number 4, loss avoidance. The loss avoidance trap is a powerful psychological barrier that causes us to make irrational financial decisions. Our brains have evolved to protect us from taking risks because losing resources could once cost lives. But in today's world, this belief often works against us, especially in finance. Imagine the situation. You invested $1,000 in a stock, but its value has dropped to $700. Instead of selling and using the remaining money more effectively, you hang on to that stock, hoping it will return to its original price. Why? Because the fear of locking in a loss is psychologically stronger than the opportunity to use that $700 for a more promising investment. How to get out of this trap? Look at money objectively. It's important to remember, money that's already lost can't be recovered. Instead of focusing on what I lost, ask yourself, what can I do with what I have left? Appreciate the potential, not the history. A common mistake is to cling to an investment because a lot of time or money has already been invested in it. This is the so-called sunk cost mistake. Make decisions based on current data and future potential, not the past. Don't be afraid to take risks. Financial success rarely comes without taking reasonable risks. If you always choose absolute safety, you're missing out on growth opportunities. The key is to take risks intelligently. Analyze the market, consider potential losses, and be prepared for them. Practice financial absolution. If an investment is unsuccessful, recognize it and move on. The ability to let go of unprofitable assets is not a weakness, but an important skill for a successful investor. Remember that any loss is a lesson learned. The main thing is that it teaches you to act smarter in the future. Fear of loss is a natural emotion, but it shouldn't drive your decisions. Sometimes the best way to move forward is to take a step back, reevaluate your options, and choose a more profitable path. Trap number 5, the possession effect. The possession effect is a trap that's easy to fall into because our subconscious mind associates the value of an object with the very fact of possession. Once an item becomes ours, it seems more important to us than it actually is. This leads to unnecessary spending, accumulation of junk, and inefficient use of resources. A simple example. You bought a gadget for $1,000, but over time its market value has dropped to $500. When it comes time to sell, you resist, thinking, but I spent $1,000 on it. However, the question is, would you buy that same gadget today for $500? If the answer is no, then why hold on to it? Trap number 6, illusion of control. The illusion of control is one of the most common traps, especially among investors. It's when we think we can influence something that actually depends on external factors, such as the market, the economy, or even basic luck. Why does this happen? The human brain craves predictability. We want to believe that our actions directly influence outcomes, especially in areas where we make decisions, such as investing. We think, I've done the analysis, so I've done the math, but the market is unpredictable. Sudden economic events, government decisions, or just the mass mood of participants can change the situation in a matter of minutes. Trap number 7, the planning mistake. The planning mistake is a classic one faced by almost everyone who makes a budget, whether it's for personal expenses, a business, or an investment project. We believe we're in control, but reality loves to spring surprises, unexpected spending, forgotten little things, or changes in circumstances. Our brain is prone to the so-called optimism bias. We underestimate the likelihood of unexpected expenses and believe that everything will go according to plan. In reality, there are always hidden factors that can derail any, even the most carefully considered budget. Trap number 8, overconfidence. Overconfidence is one of the most hidden but dangerous traps, especially in the world of finance. It causes us to overestimate our abilities, underestimate risks, and, as a result, make decisions that can result in serious losses. Humans tend to look for confirmation that they are right, ignoring facts that may point to errors. This cognitive distortion is amplified in areas where we have little experience. If you once successfully invested money or predicted a market trend, you may feel like you've figured it out, when in reality, the success may have simply been the result of luck. Trap number 9, the sunk cost fallacy. The sunk cost fallacy is one of the most common traps that prevent us from making rational decisions. Its essence is that we focus on the resources we've already spent, money, time, effort, and don't want to let go of an unprofitable project or unnecessary asset. It has to do with our psychological attachment to what we've already invested. We tend to view past investments as an investment that needs to be justified. For example, If you invested $10,000 in a startup that started making losses, you find it hard to stop because it seems like just a little more and it will get better. In fact, this money has already been lost, and further investments will only increase losses if the project has no prospects. The key principle is that you cannot get back the money you have already spent. It is important to think not about the past, but about the future. Will the project or asset bring value in the future? Trap number 10, confirmation of biases. Confirmation bias is one of the most hidden but dangerous cognitive traps, especially in finance. It's when we are more willing to notice and accept information that aligns with our beliefs and ignore anything that contradicts them. When you refuse to accept alternative viewpoints, you deprive yourself of the ability to objectively assess the situation. This limits your analysis and makes decisions less effective. For example, if you believe that a certain market, such as real estate, can't collapse, you will ignore the warning signs and continue to invest even if the risks are rising. And if you know any other financial traps people fall into, or want to share any of your thoughts, be sure to post them in the comments. See you soon, dear friends.